But what is the real risk is not a sudden crash, but something far quieter and more structural. A slow compression where markets stop compounding the way investors have come to expect. We are entering a period where traditional relationships are shifting. Yields falling no longer automatically means stocks rising. That regime worked when rate cuts signaled support. But when yields fall because growth is weakening while inflation remains constrained, the message changes. That is no longer stimulus. That is pressure. The headlines right now focus on tariffs, geopolitical tensions, oil spikes, and crypto volatility. But those are surface narratives. The deeper mechanism is liquidity transition. When leadership narrows and correlations begin rising, markets can appear stable at the index level while underlying conditions deteriorate. This is how late-cycle compression begins. Not with panic, with rotation, with failed breakouts, with rebounds that lose momentum faster each time. Now look at cross-asset behavior. Gold catching bids while equities struggle. Oil firming, keeping inflation constraints alive. Bitcoin experiencing sharp sentiment extremes. These are not isolated events. They are stress signals about capital positioning. Here's the key shift. When falling yields no longer lift equities, it suggests markets are beginning to price slower growth rather than easier money. That distinction matters. Our baseline probability remains that this is still a rotation and compression phase, rather than systemic fracture. But the pressure is building. If credit spreads widen persistently and funding markets show strain, the probability shifts meaningfully. Now, before we go further, a quick note. This discussion is for educational purposes only and is not financial advice. If you find this type of probability-based breakdown helpful, subscribe to the channel. It allows you to follow the evolving phase transitions in real time, so you can understand the sequence as it unfolds, rather than reacting to headlines after the fact. Back to the structure. In compression regimes, rallies can be sharp. Relief moves in crypto or software stocks are possible when sentiment becomes extreme. But relief is not the same as resolution. Confirmation requires broader participation, stable credit, and orderly funding. The risk scenario is not necessarily a dramatic one-day crash. It is the possibility of a long, grinding environment where markets move sideways with volatility, compressing valuations while inflation quietly erodes purchasing power. That is why optionality matters more than conviction. The discipline is not predicting the exact outcome. It is watching the confirmations. Credit spreads, breadth, treasury auction demand, dollar behavior during stress. If those remain orderly, the system absorbs volatility. If they deteriorate together, we move into a different phase entirely. The objective is not to forecast drama. It is to recognize transition. And in transitional regimes, sequence matters more than speed. That is the framework.